53, while gold slid as much as about 11% toward $4,800 after trading near 5,600. Not months, not weeks. In about 48 hours, a trade that had felt like a one-way escalator turned into a trapdoor. The common belief was simple: the dollar weakens, precious metals rise, and any dip is just a pause before the next leg higher. People said a reversal this violent could not happen unless the entire financial system was breaking. And yet it happened anyway, with the kind of speed that feels impossible until you see what actually drives the first phase of a major unwind. Institutions already understand that markets don't move on stories. They move on probabilities and funding conditions. When the probability distribution shifts, the cost of leverage shifts with it. And when leverage is embedded across futures, options, ETFs, and cross-asset hedges, the move can happen before most people even know what question they should be asking. The information gap is not just about reading faster. It is about seeing the plumbing, margin, collateral, risk limits, and the chain reaction those rules create. What I'm about to walk through is not a hot take. It's the mechanism. Because the crash in metals wasn't random, and it wasn't purely emotional. It was a credibility shock that flipped the dollar trade, exposed crowded positioning in precious metals, and then got amplified by the risk systems that keep futures markets functioning. Once those systems engage, price can move in a way that looks like panic even when the root cause is a repricing of expectations. This is the part that changes everything. The market can be right long-term and still be destroyed short-term by mechanics. Welcome to Macro Decode. This is the channel where we translate market mechanics into plain language and connect events that look unrelated until you put them in sequence. If you want analysis that follows the data instead of the drama, keep this channel close the way you keep a wise elder close when everyone else is shouting. And drop a quick comment saying where you're watching from, because the dollar is global, and when it moves, every market feels it. On January 30th, 2026, President Trump announced Kevin Warsh as his pick for Federal Reserve Chair to succeed Jerome Powell. Markets immediately treated that announcement as a signal about the rulebook. Not a guarantee, not a decree, a signal. The signal was that the next Fed could lean harder into credibility, could be less tolerant of inflation drift, and could be more willing to accept market pain in exchange for currency stability. 53% on the day. A 0.5% move in the dollar index can sound trivial, but the index is a basket, and baskets usually move slowly. When it rises that quickly, it often reflects a rush to dollars as funding, not just a casual preference trade. Global companies hedge invoices, banks hedge swap books, and investors hedge foreign assets, and those hedges can all flip from sell dollars to buy dollars when the perceived policy path changes. That buying tightens conditions everywhere because so much debt, trade, and collateral is dollar-linked. Commodities are largely priced in dollars, so a stronger dollar can mechanically pressure prices even before you debate supply and demand. And because the dollar sits at the center of risk models, a sudden dollar rally can reduce risk appetite across portfolios, pushing managers to cut exposures that were financed assuming calmer volatility. This is why the same announcement can lift the dollar, hurt metals, and still coincide with a bid for treasuries. The system is seeking safety while simultaneously repricing the cost of carrying risk. It also changes what traders infer about real rates, because even small shifts in expected inflation versus expected policy restraint can swing the hedge math that supported metals for months ahead. Then metals broke. Gold, which had been trading near 5,600, dropped sharply toward 4,800. 53 by the close. These are not normal daily fluctuations. These are moves that scream positioning and leverage, and the shock spread through the retail-facing wrappers that millions of people recognize. GLD fell as much as 13%, and SLV plunged 34%. When ETFs move like that, you're not watching a gentle change of mind. You are watching a rapid liquidation of the most convenient exits. Now pause and look for the contradiction that reveals the real story. If the market was simply pricing tighter Fed, stronger dollar, you would expect the entire rate complex to behave in a straightforward way. But the follow-through commentary pointed to Treasury yields dipping slightly. That matters, because it suggests simultaneous demand for safety and clean collateral. A stronger dollar and a bid for treasuries together often signal that funding conditions are tightening, that participants are reducing risk, and that cash is becoming more valuable than exposure. That's not a normal calm rotation. That's a system recalibrating. This is why the event is bigger than a headline about a nominee. It's a window into how quickly a regime can shift when a crowded trade meets a probability shock. To see the pattern, you have to step back. Markets have a long history of punishing consensus when the perceived rulebook changes. In 1979 and 1980, Paul Volcker's Fed signaled a willingness to confront inflation even if it meant recession. The result was a dramatic repricing of rates and risk, and a painful squeeze on positions built for easy money. The lesson was not personality. The lesson was mechanics, credibility shifts. change the expected path of real rates change the discount rate, and the discount rate determines which positions can survive. In 1994, the Fed started tightening from a very low base and surprised a market that had grown comfortable. 5% by the end of that year, a 300 basis point move that helped trigger what became known as the bond market massacre. Again, the key point is not the label. It is the speed with which assumptions broke. When the market believes policy will stay accommodative, duration and leverage build quietly. When that belief gets challenged, the unwind happens fast, because it is funded, not owned outright. In 2013, the taper tantrum showed the power of expectations. 6% in May to above 3% later that year. That move rippled through emerging markets, credit, and anything dependent on cheap funding. The mechanism was the same. Expected liquidity support was revised, and the repricing traveled through the funding chain. Now, at a metal-specific parallel that people forget when prices are rising. 50 in late April, and then experienced a violent correction that pushed prices down into the low 30s within days. That episode also featured rising volatility and tightening risk controls. The point is not nostalgia. The point is that silver, more than gold, tends to be the leverage release valve in metals. When silver moves, it often reveals how much speculative fuel was embedded in the trade. You were watching a crowded macro hedge unwind under a new set of expectations. Let's talk about the players without turning this into a conspiracy story. Start with the institutions that form the market's skeleton. The futures market runs through exchanges and clearinghouses. In U.S. metals, that includes COMEX, part of the CME group. The clearinghouse sits at the center and requires collateral so that contracts settle even when price swings are violent. That collateral is margin. Margin is not a suggestion, it is a rule. Then you have the banks and dealers that make markets and warehouse risk. They hedge dynamically. When volatility jumps, hedges change. You have commodity trading advisors and systematic funds that respond to trend and volatility signals. They respond to inputs. You have macro hedge funds that express policy views through baskets of currencies, rates, and commodities. And you have ETFs like GLD and SLV, which are liquid wrappers that allow massive flows in and out with a single click. When this machinery is calm, it feels invisible. When it is stressed, it becomes the story. After the plunge, CME raised margin requirements for gold and silver, with widely reported figures showing gold margin rising from about 6% to 8%, and silver margin rising from about 11% to 15%. Effective from Monday, February 2, 2026. That is not just a footnote. A shift like that increases the cash needed to maintain the same exposure. If you're fully funded, you can post it. If you're leveraged, you have a choice you don't want. Add collateral quickly or reduce the position. To understand how powerful this is, translate percentages into dollars. A standard COMEX gold futures contract represents 100 troy ounces. At a round number like 5,000 per ounce, that contract controls about 500,000 of notional exposure. At a 6% margin, you might need roughly 30,000 to hold it. At an 8% margin, that jumps to roughly 40,000. That's an extra 10,000 per contract, demanded at the exact moment price has already moved against you. Now do the same with silver. A standard COMEX silver contract represents 5,000 ounces. At around 80 per ounce, that's about 400,000 of notional exposure. At an 11% margin, you might need roughly 44,000. At a 15% margin, roughly 60,000. That's about 16,000 more per contract. Multiply that across hundreds or thousands of contracts, and you can see why liquidity suddenly becomes the only thing that matters. And here is why timing matters. Margin changes often arrive after volatility has erupted, which means the market can get hit twice. First by the move itself, then by the forced repositioning that follows as participants prepare for the new requirements. It's like getting knocked down by a wave and then realizing the tide is pulling out under your feet. Now connect that to the ETF behavior. GLD down as much as 13% and SLV down 34% tells you that the selling was not confined to professional futures traders. It was broad. ETFs can magnify the speed of repositioning because they provide immediate liquidity. But the ETF system must remain aligned with the underlying market through creations and redemptions. In heavy selling, authorized participants can redeem shares, and the process can transmit pressure into futures hedges and inventory decisions. In calm periods, it's efficient. In stress periods, it can become another channel that forces alignment at the worst possible time. This is also where the dislocation conversation begins. People look at physical demand narratives and ask how paper prices can collapse so fast. The answer is that paper markets are leveraged and are set by marginal trading, while physical supply chains are slower and constrained by shipping, refining, and inventory placement. Paper prices can overshoot because the marginal seller in a deleveraging episode is not optimizing. They are complying. Physical demand can exist and still not stop the first phase, because the first phase is about balance sheets, not long-term value. Another dislocation sits right beside it, the cross-asset signal mismatch. The dollar strengthened, metals fell, and yields dipped slightly. That combination suggests the market wasn't simply rotating out of metals into dollars. It was also seeking safe collateral and reducing overall risk. In that environment, metals can be sold not because people hate metals, but because metals are one of the liquid sources of cash that can be converted quickly to meet requirements elsewhere. When participants need cash today, they don't sell what they love least, they sell what they can. Now let's put hard numbers back on the table, because numbers are the antidote to vague narratives. Gold, moving from near 5,600 to around 4,800, is a drop of about 800 points. 53 after collapsing roughly 36% is a move that changes risk limits everywhere. 53% is a signal that the currency bid was real, not imaginary. GLD off as much as 13% and SLV off 34% tells you the liquidation reached into the most popular public vehicles. And the margin requirement changes from about 6% to 8% on gold, and from about 11% to 15% on silver, tell you the clearing system was actively tightening the rules of engagement. The sequence is the evidence. Catalyst, currency move, metal collapse, ETF liquidation, margin response. The order matters. Now, how was this executed mechanically? Think of it as a chain reaction rather than a single decision. Step one is a probability shock. A Fed chair pick changes expectations about the Fed's reaction function, which changes the expected path of real rates and the expected defense of the dollar. Step two is a dollar move. The dollar is the world's funding currency. When it strengthens, the global balance sheet tightens at the margin because dollar liabilities become harder to service and dollar collateral becomes more valuable. Step three is a repricing of the hedge trade. If metals had been used as protection against policy drift, then a shift toward perceived policy discipline reduces the urgency of that hedge and crowded positions begin to unwind. Here is an analogy that keeps it simple. Imagine a neighborhood where most houses have adjustable rate mortgages. As long as rates stay low, people feel safe and get comfortable. But if the neighborhood hears that the bank is about to raise rates, home prices can fall before the rate changes actually happen, because affordability expectations shift. Replace houses with leveraged positions, and replace mortgage rates with funding rates and margin rules. The move is not a referendum on the true value of the house. It is a repricing of the cost of carrying the house with borrowed money. And that is why silver often looks like a cliff. Silver is smaller, more volatile, and more sensitive to speculative positioning than gold. When the unwind begins, silver can move in exaggerated fashion because it is both an industrial commodity and a financial instrument. In risk-off moments, the financial layer dominates. When that layer deleverages, it can overwhelm the slower industrial narrative. Gold, by contrast, is larger, deeper, and often held by entities that can ride volatility. But even gold is not immune when the selling is driven by balance sheet constraints rather than preference. There is also an options layer that most people don't see. When volatility explodes, option market makers hedge differently. In some structures, hedging can become procyclical, meaning the act of hedging adds to the move, rather than dampening it. If large positions are short volatility, they may need to sell as price falls to stay hedged. If large positions are long volatility, they may take profits in a way that still pressures spot. The details vary, but the principle is consistent. When volatility jumps, the flow itself can become the driver. So what does this mean next, without pretending anyone can script the future? Historically, a move like this does two things. It resets positioning, and it changes what the market watches. After a credibility shock, the market becomes obsessed with the signals that confirm or deny the new regime: the dollar's trend, real rates, inflation data, and the tone of Fed communication. There are a few plausible paths from here, and each path has telltale indicators. A conservative path is stabilization after liquidation. In this case, the crash was a leverage flush. Once margin calls are met, once risk limits are respected, and once forced sellers are finished, prices can stop falling even if the narrative stays confusing. Volatility remains elevated, but the market starts behaving like a market again rather than a liquidation engine. You would see dollar strength become less explosive, ETF outflows slow, and intraday ranges compress. A moderate path is a regime repricing. In this case, the market doesn't just flush leverage, it reprices the whole hedge framework that had supported metals. That would mean a longer period where metals grind, not because the world is suddenly stable, but because the probability of policy discipline is higher than it was. In that environment, rallies can happen, but they are capped by cautious positioning until the new rulebook is tested and proven through data and decisions. An aggressive path is broader stress in funding markets. In this case, the dollar's strength and the bid for treasuries are not just a policy story, They reflect a collateral squeeze. If that squeeze persists, the sell-off can spread into other assets, and metals can remain under pressure because they are a source of liquidity. In that world, the key is not the metal story. The key is the funding story. Indicators like repo conditions, credit spreads, and cross-market basis levels that reveal stress before it hits the headlines. Notice what is missing from these scenarios. There is no guarantee. There is no single price target. There is only pattern and mechanism. So what should you watch, specifically to understand which path is unfolding? Watch whether the dollar index holds its gains over multiple sessions rather than giving them back quickly. One-day spikes can be emotion. Sustained strength is regime. Watch the behavior of treasury yields during risk events. If yields continue to dip when volatility rises, that signals persistent demand for safety and collateral. Watch exchange and clearinghouse communications about margin and volatility. When margins rise, it is the system telling you that the cost of leverage just increased. Watch the behavior of the most liquid public vehicles, because they often reveal whether the crowd is still exiting. When GLD and SLV stabilize relative to their underlying markets, it often signals that the worst of the sell whatever is liquid phase is passing. When they keep gapping, it can indicate the opposite, ongoing forced selling. And watch the narrative shift itself. In a true regime change, the public story lags the price. First, price breaks, then people search for a reason. Then, quietly, positioning adapts, and the new story becomes normal. By the time consensus forms, the important move has already happened. That brings us to the choice ahead, and it is not a moral choice, it is an information choice. The people who struggle in moments like this are not necessarily wrong about the long-term role of metals. They are wrong about the short-term dominance of leverage and mechanics. They treat plumbing as background noise until the day it becomes the entire soundtrack. The people who navigate these regimes are the ones who respect sequence. They ask what moved first, what was forced, and what was discretionary. They understand that a Fed chair pick can matter less because of the person and more because of the implied reaction function. They look for the exchange's response because margin rules are the clearest proof of stress and the most direct trigger of forced flow. And this is why institutions often move first and the public moves last. Institutions live inside the machinery. They manage collateral. They monitor margin. They see options flow. They see correlations breaking in real time. The public is left with a chart and a headline, and the headline usually arrives after the move has already done the damage. So take this event for what it is, a real-time demonstration that trades can flip fast when expectations, leverage, and risk rules collide. The dollar strengthened, metals collapsed, ETFs dumped, margins rose, yields hinted at a bid for safety. That is not one story. That is a regime shift in motion. This is macro decode, where we decode what matters before it becomes a clean headline. If this helped you see the mechanism instead of just the drama, you know what to do. The question isn't whether markets can move faster than seems reasonable, you just watch them do it. The question is whether you can read the plumbing early enough to understand what the tape is saying when the old narrative stops working.